Is my Senator, Senator Miller. Good afternoon.
We are live.
All right, thank you. Good afternoon, and welcome to the Spending Affordability Committee. I'm Delegate Michael Jackson, presiding chair today, along with my co-chair, Senator Craig Zucker. Today we will have a briefing from the Department of Legislative Services regarding the fiscal budget. Joining us today, we have with us the Senate Budget and Taxation Committee, headed by Senator Guy Gazzone, the chair, as well as Senator Jim Rosapep, the vice chair. We have my committee, the House Appropriations Committee, headed by Delegate Maggie McIntosh. We also have House Ways and Means Committee, chaired by Delegate Ann Kaiser and Vice Chair Alonzo Washington. So today we have a presentation in the fiscal briefing by the Department of Legislative Services, which will be broken into sections. And for each member, just so you know that after each section, we're going to take questions or comments. If there are any comments that you'd like to make or any questions you have, please click on participants and raise your hand. If you choose to go through the chat, just know that because this is a public hearing, we will be reading your chat verbatim because it is a public hearing. So before we get started, I'd like to welcome the President of the Senate, Bill Ferguson, who's also joining us today. Mr. President, if you'd like to greet us, we'd be more than happy to have you.
Sure, thank you, Mr. Co-Chair. Appreciate the remarks. Looking forward to hearing today's information. I think we've certainly been doing better than expected with big caution flags on the other side. I think we just got some interesting new data about rent repayment and the increased delinquency of rent from September to October. Which unfortunately looks to be maybe a leading indicator of some of the worries that we had that the pandemic unemployment having been expired and the PPP program running short. And so a lot of our projections, as Chair Gazzone reminds me frequently, rely on some assumptions about what federal stimulus may be coming, what expanded programs or extension of programs may be coming. So looking forward to hearing today's projections with a sense of caution and hope that we make it through this as well as possible. But appreciate your leadership on this, both co-chairs of Spending Affordability.
Thank you very much. Has our speaker joined us? Do we know that? Okay, if she does, we will cut in. So let's get right to it. Mr. Romans, you're up for an overview for us. Everyone should have a copy of the agenda as well as the 56-page document. So, Mr. Romans.
Thank you, Mr. Chairman. So we're going to go through sort of a fiscal overview today. It's going to focus initially on the general fund revenue outlook, general fund spending, our forecast for the next 5 years of general fund spending. And then we'll transition to talking a little bit about debt affordability, the outlook for the capital budget, and finally talk about the transportation trust fund. I think one of the themes to keep in mind, and the president referenced this, is there's a lot of uncertainty. This is probably the most uncertain forecast we've presented to the Spending Affordability Committee in many, many years. And it starts with the revenues. As you'll hear, the Board of Revenue Estimates has an official revenue estimate, and then it has an alternative. And you will see that the gap between those two is enormous and has serious implications depending on which direction revenues go in the next few months. There's obviously the uncertainty about the pandemic and how it's going to progress, when the vaccine is going to come along and so forth. So a lot of challenges there. And then the big unknown is federal funding. Will Congress act at some point in the next 2 to 6 months to provide additional assistance? We assume no, but obviously if they do, that could really change the budget outlook. So a lot of uncertainty. We're going to give you the best information we have at this point, and stay tuned as we move closer to December and your decision meeting. So we're going to really kick off with the revenues, and I'm going to turn it over to Teresa Chizinski, who's our expert on the economy and all things revenue.
Thank you. Maureen, are you going to start the slide presentation? There we go. So if we could go to the very first page. As David mentioned, we're going to start with the revenues, and we're going to start with the fiscal 20 closeout. This chart shows the total general fund revenues for fiscal 20 compared to the official estimate, which was done in March. As you probably have heard by now, revenues came in $102 million below the estimate. They grew 2.4% over fiscal 2019. Ongoing revenues were $144 million below the estimate and grew just 1.3%. Now, this rather limited underattainment was helped along by the fact that roughly 3/4 of the fiscal year was already over by the time the pandemic really got to Maryland. And also because in the last quarter of the fiscal year, we were receiving income tax payments for tax year 2019, as businesses and individuals were filing their annual tax returns in the spring. And 2019 turned out to be a pretty good year for income growth. And that really is what helped the personal income tax and the corporate income tax to exceed the estimate. Withholding within the personal income tax was basically right on target with the estimate and grew about 5.8% over fiscal 2019. The biggest underattainment was, of course, the sales tax, which was down by $317 million, fell 3.7%. If you look down towards the bottom of that table under the selected special funds, you can see that the revenues to the Blueprint Fund from the sales tax were actually over the estimate by 71 million. And that estimate actually had been revised upwards substantially in March. Of course, the Blueprint gets a portion of the sales tax revenue from certain remote out-of-state sellers who were required to begin collecting the sales tax after the Supreme Court decision in Wayfair versus South Dakota, which was issued in 2018. And it also includes sales tax revenue from marketplace facilitators who were required to begin collecting the sales tax on third-party sales. That was legislation that was passed in the 2019 session, and it went into effect last October. The lottery also exceeded the estimate by 18 million. The lottery likely benefited from the closure of the casinos. The casinos were closed from mid-March to mid-June. And you can see at the very bottom of this table that revenues to the Education Trust Fund were therefore below the estimate by $155 million. Now, this table also compares the actual general fund revenues in fiscal 20 to a preliminary estimate that was presented to the board in May. This was not an official estimate of the board. It was a preliminary estimate. It was presented in May, but it was actually done using an economic forecast from Moody's Analytics that was done in April. So we're talking very early in the course of the pandemic and the subsequent recession. And you can see relative to that estimate, actual revenues were $823 million above that estimate. And even the sales tax exceeded that estimate. So it clearly missed the mark by quite a lot. And in a couple of minutes, we'll get to some economic variables to see exactly where that estimate was off. If we could go to the next slide, please. Looking for a minute a little bit more closely at withholding. Withholding is by far the biggest component of the personal income tax. And of course, the personal income tax is the biggest source of general fund revenues. This is withholding revenue on a calendar year basis. And it looks at the first 9 months of calendar 2020 compared to the same period in calendar 2019. And data has been broken down by industry. So one of the reasons why withholding has held up has been some really strong growth from government agencies. This is both state and local government as well as the federal government. Part of that is the very unfortunate situation that we've had a huge increase in unemployment insurance benefits. There is withholding on those benefits and they are taxable income. But even excluding that, government withholding is up pretty strong. Some of it is the federal government, which is one of the few sectors that has added jobs this year. Some of that, but not all of it, related to temporary hiring for the census. There also was a federal COLA this year of about 3%, but there also is growth in state and local government withholding. In the private sector, we've divided it up in between industries that have seen growth and those that are contracting. In total, the private sector withholding is up 2.8% in the first 9 months of calendar 2020. Among the increasing industries are some that are quite large and also fairly high paying, like finance and insurance, the professional and business services. You may be a little surprised to see retail trade in this category. And while some retail trade sectors are down, others have grown pretty substantially, like online retailers, grocery stores, home improvement stores. Among the contracting industries is probably one of the hardest hit industries, the accommodation and food service. This is hotels and motels, restaurants and bars, of course, getting hammered by the pandemic and the recession, down 17% here in the first 9 months of the year. Also being hit hard has been the arts, entertainment, and recreation sector. This includes sports venues, performing arts. It includes the casinos are in this group, as well as museums and such, also being hit hard. So in total, withholding for the first 9 months of the year up 5.8%. If we exclude the UI benefits to kind of focus on withholding from wages, it's up 3.8%. And the other wrinkle here is that there were 7 counties that increased their local income tax rates in 2020, so beginning in January. And if we make a rough adjustment for that, withholding is still up 2.9%. So it's very significant that withholding is still growing here despite everything that has happened so far this year. Now, there, of course, was a lot of federal action in the spring to try and support the economy. Things like the extended UI benefits to people who normally don't qualify for UI benefits, as well as the extra $600 a week that helped to support consumer spending. So did the stimulus checks that went out for the most part in the spring. There was also the Paycheck Protection Program that was potentially forgivable loans to businesses if they retained people on their payroll. All of that helped to support the economy and therefore support payroll. Obviously, a lot of that has expired and has yet to be renewed. And so it remains an open question whether we'll continue to see withholding grow the way it has so far. If we go to the next slide and move on to fiscal 21. Fiscal 21, of course, started on July 1st, and we have revenue collections through the month of September, which is shown here on page 3, compared to the similar time frame in fiscal 20. This is 3 months of data for some things, but only 2 months for other revenue sources. So it's very early in the fiscal year, and you don't want to overinterpret the data, but it is somewhat interesting to see that revenues are basically flat with year-ago levels. The income tax, the personal income tax is up a little bit, mostly due to withholding. The lottery is up strongly, despite the fact that there have not been big jackpots in either Mega Millions or Powerball. This is just really strong growth in other games. The casinos down at the bottom of the table there, the Education Trust Fund is down 5.9% year to date. That's actually not too bad when you consider that the casinos are running roughly at half capacity. Most of the facilities have about half the number of VLT machines they had this time last year. Perhaps most interesting is the sales tax. The sales tax in total is up 2.6%. And I will emphasize that the sales tax here is really just 2 months of data. It's basically sales in the month of July and August. In the middle of the chart, we've broken it down into that bucket of sales tax that gets shared with the Blueprint Fund. So the remote out-of-state sellers, along with the marketplace facilitators. That is up very big, and that's because the marketplace facilitator bill only took effect last October. So there's basically no revenue in fiscal 20 for them yet. We've got $83 million so far from this by the estimates of the Bureau of Revenue Estimates. The general fund gets the first 100 million. So sometime in October, we're going to hit 100 million. And from that point forward, all the revenue, sales tax revenue from this group is going to go to the Blueprint Fund for the rest of the fiscal year. Everything else in the sales tax, so the total sales tax excluding that group, is actually down 5% in the first 2 months of fiscal 21. And if we can go on to the next slide and move on to the forecast. As you are probably aware, the Board of Revenue Estimates did issue a new official forecast in September for fiscal 2021 and fiscal 2022. The chart here is fiscal 21, and the next page will be fiscal 22. We're comparing it here to the official estimate from March. The board wrote down revenues by $673 million and expects growth of 0.4%. Compared to that preliminary May estimate, however, which we saw was way low in fiscal 20, this would be like almost a $1.4 billion upward revision. You can see under the blueprint that revenues from the sales tax are revised up by 140 million, again, reflecting the overattainment in fiscal 20 plus the strong growth year to date. The blueprint also this year gets a portion of corporate filing fees. Corporate filing fees are normally a pure general fund revenue source, but due to a provision in the 2019 Budget Reconciliation and Financing Act, in fiscal 21, the general fund gets the first $66.3 million and the rest goes to the Blueprint Fund. And that's a provision that applies only to fiscal 2021. If we move to the next slide in fiscal 22, again, compared to the official estimate, Maureen, can we go to the next slide? Thank you. That's a downward revision of $455 million, looking for growth of 5.1%. Again, relative to May, it's a big upward revision of $2.1 billion. Now, the estimate in September was done using an economic forecast for the US and Maryland from a private forecasting company called IHS Markit. They've had a lot of names over the years, but the state has a long time subscriber to their service. And their estimates were done early to mid-September. And they do assume, as was mentioned earlier, that there would be additional federal fiscal stimulus in the form of another round of stimulus checks, some extra UI benefits, although not the full $600 per week, some extra aid for small businesses. And they also have the assumption that a effective vaccine would be available by mid-2021. And if we go to the next slide, the board recognized that there's a lot of uncertainty here. So they did do an alternate forecast, as Dave mentioned earlier, in September for the three largest revenue sources, which are the two income taxes and the sales tax. And this chart shows you the official forecast and the alternate, both of which are being compared to March for both fiscal 2021 and fiscal 2022. This alternate forecast was done using a US and Maryland economic forecast from Moody's Analytics. And you can see, as Dave mentioned, that there's a really huge gap between these two forecasts. So whereas the official estimate in September was a $673 million write-down, the alternate is almost $1.4 billion in fiscal 21 and a little bit over $1.4 billion in fiscal 22. Now, this wide variation is a little surprising because both companies have actually very similar assumptions about federal stimulus. At the time these forecasts were done, which is like August and September, they both assumed that there would be additional federal fiscal stimulus in this calendar year, in the fourth quarter. They also both made similar assumptions about the availability of a vaccine by the middle of next year. So it just highlights just how uncertain the situation is, that even though they've made similar assumptions, they come to very different conclusions. And that there is a real serious downside risk to the forecast that was done in September. There's a lot of uncertainty. Economic forecasting is largely using the past to predict the future, but we're in a recession, but it's not like past recessions. We obviously haven't had a global pandemic in 100 years. So we're in uncharted territory, and it's possible we will see significant revisions to economic forecasts as policy decisions are made or not made, as the case may be, as we continue to get economic data. And that may in turn result in some significant revisions to the revenue forecast. The Board of Revenue Estimates will meet again in December and adopt an official forecast, which will be used in the 2021 session. And to highlight sort of why where these economic forecasts are different, the last two charts I'm going to talk about, the next one, if we could go there, is a graph of Maryland employment. Maureen, can we move on? Thanks. Thank you. So we're looking at the year-over-year percent change here in Maryland employment for 2021 and 2022. The yellow bar is the actual, which is through the month of September, and it's down 5.8%. Interestingly, that May forecast, that preliminary May forecast, did a pretty good job of projecting the path of employment this year, forecasting a 5.2% decline. And the green bar is IHS. That was the basis for the official September forecast. They're also down 5.3. Moody's is the basis for the alternate, a little bit more significant decline in 2020. But the bigger difference is in 2021 and what happens then, with IHS having a much more substantial rebound of 3.8%, Moody's having just a very small growth in employment next year. And another way to look at the economy is, of course, via income. And if we can go to the next slide, this is a similar sort of comparison using income growth on, again, of a year-over-year percent change. Income here is being measured as Maryland earnings. So it includes wage and salary income. It includes the small business income of individuals from things like sole proprietorships and partnerships. And it also includes an adjustment to capture the earnings of Maryland residents who work in other states. So it's a more holistic look at income rather than just focusing on wage and salary income. It is Maryland earnings, so it does not include things like unemployment insurance benefits. The actual is a little hard to see, the yellow bar, because it's basically flat. We have data here through the month of June, and it's basically at the same level as it was for that period in 2019. And this is really where that May forecast was quite off. It had forecasted a decline in earnings of about 4% for all of calendar 2021. IHS has about a 0.7% decline, and Moody's has a 2.4%. This is really illustrates why IHS was used for the official forecast. It is a little bit more consistent with the year-to-date, not only in terms of this measure of earnings, but also in terms of the withholding data we talked about earlier. I will say that though at the time IHS and Moody's did their estimates back in August and September, they did not have second quarter personal income. That only came out in late September. So at the time, all they had was the first quarter data, which is January through March, and was obviously largely before the pandemic and not of particular value to estimate what's going to happen going forward. And as with employment, the big difference is in calendar 2021. Again, IHS having a pretty strong rebound. Interestingly, their rebound is almost entirely coming from wage growth. They actually have that component that's business income from small businesses continuing to fall in 2021. And actually they have a much sharper decline in 2021 for that than they do in 2020. Moody's has sort of a modest rebound in business income and a small growth in wages in 2021. And this difference is really the main reason why there's such a big variance between the official and the alternate revenue forecast. And that concludes my section, and I would be happy to take any questions.
Do we have any questions from any of the members? If so, hit
Yes.
raise hand feature. I don't see any.
Senator Rosebeth, was that you?
Yeah, that was raising my real hand, but now I got it.
Okay.
Okay.
I just want to remind members, we will not see you. If you physically raise your hand, we will not get to see you. So either text me or use the hand raise feature like you are doing right now, Senator Rosebeth. Thank you.
Great. Thanks very much. It was a very, very, very useful presentation. I wanted to just dive in a little bit more on the difference between the estimates and see if I understand it correctly. Essentially, you're saying that Moody's and IHS made similar assumptions, except about job growth. Is that the bottom line?
Well, yes, between job growth and the knockoff effects on earnings growth from weaker job growth,
Right.
resulting in slower wage growth and so on.
That answers my question. I just want to be sure I understood it. Thank you.
Thank you, Senator. I'll move next to Delegate Lukey.
Thank you, Mr. Chairman, and Teresa, thank you for the presentation. So going to gaming revenue for a second, you mentioned the lottery's been overperforming and the casinos are still at half capacity, but do we have a sense of how they're doing versus the same, a 1 month period last year, rather than looking at the whole annual revenue, which would take into account the closure?
Well, in the first 3 months of the year, fiscal 21, so you're comparing July through September of this year to July through September last year, but there's no closing in either of those periods. But this year they're at half capacity, and that is down. The ETF was down 5.9%. They actually were over, if you look at just at the month of September, total gross revenues were actually a little bit higher than year ago levels. Not only for table games are quite erratic. So they can go up and down, but even the VLTs in total were a little bit higher than year ago levels. So they are managing to generate a fair amount of revenue despite the limitations on the number of machines that they're running.
Thank you.
Thank you. Mr. Chair, I don't see any other House members or senators. So.
No, I don't either, Mr. Chairman.
All right, we can proceed. David, you're back on.
Yep, Maureen, can we go to the next slide? All right, so we're going to turn now to sort of looking at the big picture, putting together the BRE official revenue estimate with the DLS forecast of spending. So this first chart focuses just on fiscal 20 through fiscal 22. A lot of numbers. Focus on that box in the middle and really the first line in the box, which is the cash balance. So we closed fiscal 20 with a 703 million fund balance, which largely reflects the availability of federal CARES money and Medicaid enhanced match to relieve the general fund of costs that we expected. That really helped us out fiscal 20. And then the revenues performing better than expected. Now for fiscal 21, we're projecting about a 547 million surplus. And again, this is largely due to the availability of federal dollars to help offset what normally would be general fund costs. And again, it uses the official BRE revenue estimate. For fiscal 22, the picture changes a little bit, goes to about $856 million shortfall, again, on a cash basis. And so that's sort of the challenge, at least at the moment, that we see for you going forward. Now let's go to the next. Let me just add just a couple of things here. One is we have incorporated into this forecast the governor's announcement of the Economic Recovery Initiative, where he would use $250 million from the rainy day fund. If not for that, that $250 million would have helped to balance the fiscal 22 budget. And the other thing to note is even with the governor doing that, we are showing a rainy day fund balance here at the end of fiscal 22 of $1.2 billion. We left the rainy day fund at 6% of general fund revenues. The reason we did that is that's been the Spending Affordability Committee's policy for the last few years. Prior to that, we often went down to 5%, which would free up nearly $200 million to help balance the budget. So there is some cash there that could make this picture a little bit better. Let's go to the next slide. All right, I'm sure everyone's thrilled to talk about baseline budget assumptions, but there's a couple of important things to know. The first is we are relying on enhanced Medicaid match in our assumptions for fiscal 21, continuing through the end of March. The enhanced federal match is available as long as there's a federal emergency declaration in place at the start of a quarter. And so we're assuming at least through January that emergency declaration will be in place. Now, if that continued beyond March, if it continued into April, we would probably generate another 160 million or so of federal funds in fiscal 21, which would offset general fund spending. So that the timing of when that emergency declaration ends is a big deal and impacts the forecast. The second thing to note, I mentioned this earlier, is we did not assume that any additional federal stimulus would help balance the state budget. So if we get some money in November, December, or in the next year that can be used to help balance the budget, that will provide relief against that shortfall we're showing for fiscal 22. At the bottom of the page, we're showing the caseload assumptions that we used. Medicaid and temporary cash assistance have grown a great deal, as you would expect, in fiscal 21, and you can see our forecast for the full fiscal year shows both of them quite a bit higher than fiscal 21. Other thing to note in this chart is that first line, the pupil enrollment for K through 12 education. So the fiscal 22 number reflects September enrollment for the current school year. This was done before the state board met yesterday and changed how they're going to count students. They changed it to include in their counts children who do not have proof of immunization. We did not assume that in our baseline. Adding those additional students, it's more than 20,000 additional students would get added to this enrollment count. We'll add about $109 million to our forecast. It's not reflected there. So there is some additional spending pressure coming from K through 12. And this is, again, is an example of the uncertainty we're going to see, I think, in the next few months. The state is still reacting to sort of the impacts of the pandemic, and there's policy announcements on a relatively regular basis that impact the forecast. So in December, we will try to capture all of those moving parts once again and give you a sort of a picture where things stand. Next slide. One other thing I just want to mention on personnel, we assume no salary increases from state employees in fiscal 22. We did assume that fiscal 21, there's scheduled to be a January salary increase this coming January. We assume that that 2% increase goes forward. With one exception, we had assumed that a couple of the bargaining units had negotiated away that 2% back in June when things looked so bad. We assumed that they had given it up. The governor apparently has renegotiated with them in the last week or so, and they are now also going to get the 2%. It really is a minor impact on our forecast, but it has a very small amount of cost. All right, let's turn to the next slide. All right, moving away from the assumptions, now we want to show you our outlook for the sort of 6-year period, fiscal 21 through 26. A lot of information here, but let's start with the blue bars. The blue bars reflect the official BRE revenue forecast married with the DLS spending estimate. You see in 21, we expect there to be a surplus. And then pretty much throughout the rest of the period, we're showing a shortfall in that $800 to $1 billion range. The red bars show you what happens if the alternative revenue forecast is used. And then we also added a little bit of additional spending on entitlements if the economy is weaker as that alternative forecast assumed. And you can see that dramatically changes the outlook, creating almost a $2.5 billion budget shortfall in 22, and shortfalls above $1.5 billion in each of the subsequent years. As Teresa alluded to, so far we seem to be progressing much closer to the blue bars than the red bars, but there's some risk that that won't be quite as good as what the blue bars are showing. Now, the other thing we're trying to do in this graphic is the dotted lines, which shows you the fiscal impact of overriding some of the more significant, from a fiscal standpoint, vetoes that the governor did after session. The bills that we've incorporated here include the Kerwin bill, and that brings along with it the Built to Learn Act, the school construction bill, because that was contingent on the Kerwin bill. The historically Black colleges and universities, where there was a mandate to provide about $58 million a year for 10 years. And then on the revenue side, we've incorporated the planned increase in the tax on tobacco products and applying the sales tax to digital goods. So that's the set of bills. There were a lot of other bills that were vetoed also. They don't have the same magnitude of fiscal impact. So the blue dotted line should be compared to the blue bars. And really what you see is it doesn't really change the outlook for fiscal 22 through 25. It's only in fiscal 26 when you start seeing a little bit of a gap with if you were to override those vetoes, with things getting a little bit worse. And that's because by fiscal 26, you start needing to use some general funds to help fund the Kerwin program. If you rolled it out even further, that gap would get larger as the Kerwin costs get more substantial. And the red dotted line does the same thing against the alternative forecast, and it's really the same picture with really not seeing an impact until fiscal 26. Next slide, please. All right, this looks at the structural budget outlook. So in this one, the red line is the baseline forecast with the BRE official revenues, and the green line is the alternative revenues. And again, like you saw in the cash, pretty substantial gap between the two. One thing that's kind of interesting is that the lines, the gaps get smaller over time. We don't often see that in our structural budget outlook. So it does suggest, to the extent that some progress can get made in fiscal 22 on closing that structural gap, that you can get to the structural gap to a point that's pretty manageable down the road, which is promising. The blue bars just show you, they should be compared to the red line, just show you again what the veto override impacts would be. And it's pretty much the same picture as you saw on the cash, with really not having an impact until fiscal 26. All right, let's go to the next slide. All right, we have two slides. They're going to relate to the Blueprint Fund and the Education Trust Fund, and then the Kerwin bill. So this first slide shows you that in our baseline forecast, we did not spend very much of the Blueprint money or the Education Trust Fund money. And the reason for that is statute for the Blueprint Fund dedicates that money to implementing Kerwin, which with the veto in place, there is no additional cost in those out years. And the Education Trust Fund, of course, as more and more money goes into the lockbox, with all of it going in 2023, is supposed to be used for education enhancements. And we didn't assume any new education enhancements in the out years. So what that means is that we leave unspent at the end of fiscal 22, $952 million. And that amount keeps accumulating over time, so that by the end of our forecast period in 2026, we have unspent $4.8 billion of money dedicated to education enhancements. All right, so let's go to the next slide. So now this next slide focuses in just on the Kerwin bill and House Bill 1, the Built to Learn Act, and the sales tax on digital goods that was dedicated to the Blueprint Fund. And again, there's a lot of numbers, but I would focus on that bold line and bold row in the middle, which shows you the fund balance in the Education Trust Fund Blueprint at the end of each year with the veto overrides. It actually gets bigger in 22 because the sales tax and digital goods would generate revenue, but any kind of veto override done in January would not force the governor to spend any of the money in fiscal 22. And then you can see it starts declining as the Kerwin bill is implemented in subsequent years until you get to a negative balance of 165 million in 26 when the costs overwhelm the available special funds. The bottom of the chart looks at the general fund impact, and it's fairly negligible for fiscal 23 to 25 with just some costs related to the Build to Learn Act, which mandates some spending. And then you see in 26, the general fund starting to absorb some Kerwin costs. So that's sort of our overview of the big picture on the budget outlook. The next section gets into a lot of detail on fiscal 22's budget, but I'd be happy to answer any questions on the big picture at this point.
All right, any question from members? And David, before, let me ask you a question. Dorchester County just decided to pull their students back. So we're talking about student enrollments. Should something change with COVID during the school year, will that have an impact, or do you foresee that having an impact as we go forward?
Well, the funding for fiscal 22 is based on the September 30 enrollment from this September. So whatever that enrollment count was, which includes all the virtual students, is what will be used for fiscal 22. So then the funding for future years would depend on where enrollment bounces back to or ends up, next September. Our forecast assumed the enrollments that we were assuming pre-pandemic. So we assume everything kind of gets back to normal in terms of school enrollment in the out years.
Okay, thank you very much. And just like to mention that the speaker has joined us on the YouTube side of things. Delegate Sample Hughes.
Thank you, Mr. Chair. And David, thank you for your presentation today. Very informative. This is my first Spending Affordability Committee meeting, and you had touched on the Medicaid information as it relates to, naturally increasing. I guess my question is, I was just looking at a news report this morning and talked about when the vaccine becomes available for COVID-19, of how we would include that into our Medicaid recipients. How would you plan for something like that? How does that estimate in this big grand scheme of forecasting?
We did not build any estimate of costs related to that into our forecast. Now, our Medicaid expert, Simon Powell, is on the call. I don't know if he has anything to add to the rest of your question.
Sure. Hi, this is Simon. Basically, at this point, we built into the there's a lot of testing assumed, testing costs assumed in the Medicaid budget, but there aren't specific costs assumed for the vaccine. It's unclear at this point, for example, whether there might be federal dollars outside of public assistance programs that might cover those costs. But the expectation will be that if a vaccine is available and when it's available, that Medicaid recipients will get that vaccine and Medicaid will cover it. And at that point, we'll have to take a look and see what the budget looks like and whether it's, whether the costs could be covered by the existing budget or whether there'll have to be, additional appropriations at that point.
Okay, thank you. Thank you for the answer.
Thank you very much. David, in your analysis, you spoke about what the veto overrides would look like when we talked about the spending legislation, but did you include in your analysis what we would get in revenue if we overrode some of the revenue bills that we have?
Yes, the analysis included overriding the veto on the tobacco tax increases and overriding the veto on the sales tax on digital goods. So those are built into those numbers.
Okay. Senator Rosebeth.
Thank you. I wanted to pursue Delegate Sample Hughes' question a little broader. Do these projections essentially assume that in FY21 and FY22, all or most incremental costs related to managing the virus from a health point of view will be covered by the federal government?
Yes.
Okay, thank you.
Thank you. Next, we'll go to Delegate Valentino Smith.
Thank you, and greetings to all. Just continuing to follow up on the Medicaid budget. Have we seen significant savings in the Medicaid budget for the last 7 to 9 months because of the number of people that were not seeking hospitalizations and/or hospital care because of the pandemic?
I'll let Dr. Powell answer that.
Thanks, dude. Initially, when we actually looked at this, it was more in May. There was definitely a drop in Medicaid spending. Managed care organization spending, the MCO spending was obviously up because we were seeing increased enrollment. All of those enrollees were going into managed care organizations. So we were certainly spending more in capitated rates, but we were definitely spending less in inpatient and outpatient. However, more recently, because of especially like the HSCRC's decision, for example, to allow hospitals to increase charge per case to generate revenue under the global budgets, we are seeing a kind of like a strong, a bit of a rebound there. So there are definitely areas in Medicaid where costs are down. Dental spending, for example, fell dramatically. I mean, almost 3/4 of dental spending fell off in the last quarter of fiscal 20. But elsewhere, it was actually remarkable how resilient Medicaid spending was. Now, I'm talking about the somatic side of it. On the behavioral health side, we still have very little idea what's going on that side because of the troubles that the department has had transitioning between its administrative services organization. And so frankly, on the behavioral health side, it's a bit of a black box. We really don't know what's going on that side. But generally, after an initial drop, I think spending has picked up again.
Thank you. And can I, Mr. Chair, can I ask a second question?
Yes.
On temporary cash assistance, we're seeing the significant change. And is that with respect to the, what we're getting from the federal government, or you expect to get in the TANF funding, or is that straight state change?
We're seeing a bit of both on the temporary cash assistance. We're expecting to see, we're expecting the use of some CARES Act funding to support temporary cash assistance in fiscal 21, but also some general funds, as well as using additional TANF funds that are available. So it's a combination of all three.
So that the percent change is a combination of all three.
Mm-hmm. Yeah.
Thank you. Thank you, Mr. Chair.
You're welcome. Thank you. Thought I saw Vice Chair Washington. Did you drop off? If so, we'll go with Delegate Solomon.
Thank you, Mr. Chair, and thank you, David, for your presentation. I wanted to follow up actually on Delegate Jackson's original question around the attendance numbers. I know in Montgomery County, they were projecting the potential loss of state revenue from attendance numbers as around 50 million, and then obviously that would have a ripple effect on federal education dollars. Do you all have any calculations of what that'll look like overall? And if we have a significant drop in federal revenue, federal money coming in for education, plus potential drop in state share to local school districts, how that would impact overall government hiring and what the potential the total fiscal amount could look like on those cuts?
I mean, even with the enrollment forecast that we used, education spending went up a little bit, but it certainly went up less than I think the counties would have expected with the normal enrollment. But as I mentioned, with the change the state board made yesterday in terms of how they're counting enrollment, some of that issue is mitigated. In terms of the federal funds, I'm not the best person to answer that. I know Rachel Heiss is on the call. I don't know if Rachel wants to add anything on that side of the issue.
Hi. So I'm not on the federal funds. The largest amount of federal funds comes from Title I, and the free and reduced price meal enrollment is actually up in our baseline numbers fairly significantly, which we're assuming is related to families, suffering economically under the pandemic and more students becoming eligible for free and reduced price meals. So to the extent that, since those are the largest amount of federal funds, there might actually be more available than the school systems were expecting.
I'd imagine we'd probably see a drop in the IDEA then on the special ed side.
Special education, the preliminary figures, and let me just stress that the figures that we are using in baseline estimate are self-reported from the school systems, and they are preliminary. They will submit their final, and I say final because they're still subject to some tweaking, but they'll submit their final numbers in November. We'll have a much better sense, but based on the preliminary numbers, special education enrollment is down about almost 9%.
Great. Thank you, Rachel. Thank you, David.
All right. Thank you. Seeing no more questions, David, or you want to move to Simon?
I think Simon's going to talk to you about the next section.
All right. Yeah.
Thank you. If we go to the next slide, please, Maureen. So this kind of slide it kind of underscores what David was saying about the fiscal 21 budget. You can see to the left of the chart, the blue bars are areas where we've got increased pressure on general fund spending, primarily from the economic dislocation caused by the pandemic. We're looking at entitlement spending growing by $365 million. Medicaid, as David mentioned, enrollment has grown significantly. We're currently at 85,000 enrollees above the level we had in March 2020. And we're projecting that the average monthly enrollment in fiscal 21 will be about 125,000 higher than in fiscal 2020. Temporary cash assistance enrollment, again, it's almost double the amount that was budgeted in 21, so we're seeing pressure there. Teresa mentioned the fact that education trust fund revenues were short in both fiscal 2020 especially, but also likely in 21. And we're assuming that we're going to have to backfill that with general funds, almost $182 million in fiscal 2021. But as David said, we also have a lot of one-time federal dollars to help us out in fiscal 21. The largest of which is this Medicaid enhanced match. It's a 6.2% match on eligible expenses, and we're assuming we're going to get that for 3/4 of fiscal 21. We're also assuming that the governor will use CARES Act funding in fiscal 21 to offset general fund expenses, primarily in the area of law enforcement salaries in the state police, general services, and natural resources. There's also a little bit of additional funding, one-time Medicaid funding available in fiscal 21. As David said, this enhanced match is an important source of relief, general fund relief to the state. We have had, though, some difficulty in actually nailing down the precise amount of the enhanced match that we are going to get. Specifically in fiscal 2020, both us and DBM are questioning what the Department of Health actually did account for in fiscal 20. We think it's too low. So we think there'll actually be a little bit of additional enhanced match from fiscal 20, which will be available in fiscal 21. And the Department of Health is currently trying to nail that down for us. So while this overall, you can see that there's actually an overall net savings to fiscal 21 spending because of this additional one-time and federal funding. But as you can see from the next slide, Maureen, if you can just go to that, Maureen. For fiscal 22, when we compare the fiscal 21 adjusted baseline, adjusted 21 to the 22 baseline, you can see that we're making the assumption that a lot of that one-time money in fiscal 21 is no longer available. And yet the ongoing expenditures are still there. We are expecting Medicaid enrollment to hold steady, not grow too much more in fiscal 22, but at least to hold steady. And temporary cash assistance, while it might fall a little bit, it's still going to be much higher than we would have otherwise projected. So about $719 million in general funds is needed just to backfill for the federal funds that we are using in fiscal 21. That's 719 out of a projected growth of 2.4 billion in the fiscal 22 baseline, which is 12.4% growth. The next largest growth is in the reserve fund, most of which is a technical matter appropriating $519 million to the rainy day fund. The rest of this chart, I think we could better look at that on the next chart, Maureen, which shows essentially when you take away entitlement growth and you take away the rainy day fund appropriation, you have about $900 million of spending that we're adding, that we believe will be added to the fiscal 22 baseline. A lot of this will be very familiar to you, to those who've looked at the SAC charts and fiscal briefing charts over the year. We're expecting growth, for example, in personnel, primarily in health insurance, as well as annualizing that 2% COLA David mentioned that's effective January 1st, 2021 for most employees. We're expecting increases in the dedicated purpose account, getting the WMATA funding back to $125 million in general funds, for example. Also an additional supplementary retirement payment, as well as transfers to program open space. Debt service funding, we're expecting to increase by $103 million between 21 and 22, and my colleague Patrick Frank will talk about that more in a moment. Local aid, we have it on this chart at $100 million. As David said, that's actually going to increase by at least double that based on the new enrollment numbers used by the State Board of Education. Higher education, we're expecting growth of $98 million between 21 and 22. Now, I should note that that is not the full restoration of the cuts that were taken by the Board of Public Works in July. Higher education was the one sector of state government that got hit pretty hard in the July Board of Public Works reductions. We are expecting that to bounce back a little, quite a lot in fiscal 22, but not to the full extent of the cuts made by the Board of Public Works. In terms of the Development and Disability Administration, we're expecting growth primarily because of the rate increase, 4% that providers that get based on the minimum wage bill. That rate increase is also applied to behavioral health and long-term care services. Adds up to about $100 million worth of general fund costs in the budget as a whole. Elsewhere, just point out a couple of things. In the 2020 session, there were a couple of pieces of significant legislation which added significant costs to the budget for fiscal 22. That relates to increasing salaries and staffing ratios at certain state-run psychiatric facilities. And also, there's a really large increase in funding associated with the Justice Reinvestment Act. $17.7 million. This is based on our calculation of the formula increase required under that bill, under that act, and it's based on a significant reduction in the sentenced prison population that we've seen because of the pandemic. So that's kind of like an overview of the main components of what's included in our fiscal 22 baseline. In the appendix, there's a whole series of charts that add a lot of detail, but I think at this point, that's where I'll leave it for now unless you've got any questions.
Thank you, Simon. We do have a question from Delegate Corman.
Thank you, Simon. I hope you're in District 16 right now giving this presentation.
Indeed.
Fantastic. I think you jumped over Sellinger just now when you were going through the increases.
I was leaving that for you to bring up, Delegate Corman.
Well, you cut me off on WMATA, so I'll go with Sellinger.
Yeah, that's the statutory increase that's built in based on the formula.
And so that's a $33 million increase. So do you know what the baseline number is?
No, off the top of my head, I can't remember. I'll get back to you on that.
Great. It was 18. It was 18 initially.
18 million growing by 33 million. Okay. Thank you. Thank you, Mr.
Chair. Because it was two fiscal years that got cut.
Thank you. Thank you, Mr. Chair.
You're welcome. Seeing no more questions, back to you, David.
Yeah, so the next section, we're going to look at debt affordability, and Patrick Frank is our analyst in that area.
Yeah, the debt affordability ratios are a limit that the state has put on itself to manage its own debt. What this supports is the state's capital program, and Matt Klein will come up next with some slides about that. The state has two ratios: that debt service cannot exceed 8% of revenues and that debt outstanding cannot exceed 4% of personal income. In the last 5 years, since 2015, the state has, or I should say, Spending Affordability Committee has limited debt increases to 1%. And so the growth has been very moderate in recent years. What the chart at the bottom shows is how what we project these ratios will be over the next 6-year period. And as you can see, even in the alternative forecast, which is the less optimistic forecast, we are still at our ratios. So if the economic forecast is correct, we anticipate that we will not breach these ratios. Next slide. All right, this shows how we pay for the debt service. This is the annuity bond fund, which pays for it. I think the most important line in it, as Simon's already referred to, is the general funds line, kind of in the middle of the page. It's blocked off there. What's happening here is we expect about $234 million in general funds are necessary in fiscal 2022, and that's going to climb to $500 million. One of the reasons the number is lower than it otherwise would be is the second line you see in there, the bond sale premiums. There's a slide about that next, but the short story in here is that because of changes that bond counsel advises, we're probably not going to collect as much as we otherwise would have, but we'll still collect a fair amount and in bond premiums that we can use for debt service. So we're going to go ahead and we apply those. And so that's why we have this increase from about $130 million to $500 million. As we expect these premiums to decline in the out years, that level of support will decline and the general fund needed will be a little bit more. Next slide. All right, this last slide of mine, it talks about the changes in the bond sale premiums, that policies that are recommended by our bond counsel now. The top of it, I want to make it 2 points. First of all, is that the reason we're having premiums, there's economic reasons for it. And that is that the state issues fixed rate bonds. And what happens is if the interest rates or inflation increase over the period of the bonds, which are 15 years, then the value of those bonds declines. And so the way that investors protect themselves for that is to buy bonds at a premium. And then what they do is they're moving forward their payments. So in other words, if your money is going to be worth less in the future, the sooner you get it, there's an advantage to that for you. The second thing is it's probably best to go ahead on these things and let the underwriters market these bonds. And so what we've had in the past is a policy of letting the underwriters determine what's called the coupon rate, which is the rate that's paid out. And they're the ones who want to market at a premium because that's what the market is asking for. And so this is really a market phenomenon. Now, what's happened recently, we found out just since the last bond sale, is that our bond counsel used to have a very broad interpretation of how much of those premiums you could apply to debt service. That they now have changed it and they have a much more narrow definition. And what the definition basically is only the first 3 years of interest of that bond sale can be supported by the bond sale premiums. And so we expect that the next bond sale in the winter is going to be $535 million. When I run the amortization table, I get about $72 million in debt service for those first 3 years. And that's what we're applying then as a peak for that, as a limit for that. Now, what we also expect is there's a good chance if market conditions stay as they are, that these premiums could exceed the level that $72 million that we're estimating. And so that point, you have two choices about what to do with it, really. The first is to authorize the additional money in the capital program. And the second is what you can do is resize the bond sale. In other words, reduce what you're selling so that you only sell as much as you need for your budget. And then what happens is you have to get an out-year savings for that. So we ask that you consider, as you think about these things, how you would want to handle these bond sale premiums. And that concludes my presentation. I'm happy to take questions.
Mr. Chairman, you're muted. I don't see any questions.
I'm sorry. Madam Speaker, would you like to address us before we move on?
No, I'm listening. We got a lot still to cover, so just continue on.
All right, thank you. David?
Yeah, so we're moving on to the capital budget, and Matt Klein is going to give you a nice succinct summary of where we stand.
Thank you, David. I've got 2 slides that provide an outlook for the GO bond side of the capital budget. As Patrick had just indicated in the previous section, the Capital Debt Affordability Committee has recommended a bond authorization level for the forecast period that is lower than what the Spending Affordability Committee had recommended last year at this time, and lower than what the current capital improvement program plan presented by the governor in the 2020 session. So if you look at the chart on page 22, you'll see that compared to the Spending Affordability Committee's recommendation, it's a slight reduction of 10 million a year or 50 million through the 5-year planning period. However, for the comparing it to what is currently programmed in the CIP, the recommendation by the Capital Debt Affordability Committee would be 60 million under on an annual basis, so 300 million in the 5-year planning period. But more importantly, 240 million less than what is already programmed in the capital improvement program that was presented by the governor in the last session. Next slide, please. The next slide tries to show where the current level of recommended authorizations compared to a number of commitments and a number of additional pressures. So the top of the chart shows the the Affordability Committee's recommendation for fiscal 2022 at $1.095 billion. The next line in there is something Patrick alluded to in the previous section, which is bond premiums. This is the amount of bond premium in excess of what bond counsel says we can use for debt service from the last bond sale in July. So that's 31 million. So that gets you to $1.126 billion. But comparing this to some of the commitments that have been made and to the level of programmed funds in the current CIP, under commitments, you can see the $1.055 billion, which was the amount programmed in the CIP. But there are a number of other commitments and pre-authorizations, which total roughly 190 million. Things that the legislature's committed to or projects that the legislature has made commitments to, even in some of the grant loan programs, that would put additional pressure on the capital budget and on the availability of GO bond funds. This chart offsets some of that for some known project schedule differences compared to last year at about 60 million. So it's about $1.185 billion. So it's fairly close. And certainly the administration is not going to do all of the things that were pre-authorized last year by the General Assembly, and that will provide some additional flexibility. The next section of this chart, though, however, touches on some additional pressures that may result in the use of GO bond funds over and above what is currently programmed. The first part is roughly 78.2 million of bond replacement for PAYGO general funds in the baseline over and above what is already programmed in the CIP. The next is legislative initiatives. The number here is 45 million because this is roughly the estimate of the amount of legislative initiatives over the last 3 years. There's currently no allotment in the CIP for this, so this would be over and above what is already available. And the last line in there is 15 million of bond replacement for reductions to capital general funded programs that were already taken to the Board of Public Works in July. So this puts you at about close to 200 million over and above what is currently available. Now, as I said earlier, a number of these commitments and pre-authorizations are things that the governor may not include in his budget when they try to restructure the CIP. But the point is that the current level of authorization is already below what is committed in the CIP, and there's additional pressures based on actions that the General Assembly has taken over the last couple of years. And that concludes my section. There is a section on the general fund forecast for PAYGO in the appendix. I'll take any questions at this time.
All right. Thank you, Matthew. I do not see any questions. So David, continue.
So our last section is on the Transportation Trust Fund, and Steve McCulloch, our transportation guru, is going to walk you through it.
I'm sorry, can everybody hear me?
Yes.
Okay, so the graph on page 24 gives you a snapshot of the impact of the pandemic on the Transportation Trust Fund. This compares on total revenues the 2020 January forecast with the draft forecast for the trust fund that came out in September of this year. And it only looks at the 5 years that the two forecasts overlap. So fiscal 2021 through 2025. And as you can see from the chart on page 24, the draft forecast anticipates just over 1.5 billion less in revenues state revenues going to the trust fund than we expected in January. Next slide, please. Okay, this slide then breaks out those revenues by revenue source. And you can see that motor fuel taxes has the largest decline, about 695 million. Operating revenues are greatly impacted, coming in about $426 million less. And you can also see in the middle there that except for the fact that we got, or including in for fiscal 2021, $144 million of CARES Act funding that supports transit operations, that 1.5 billion would actually be close to 1.7 billion. Next slide, please. So this chart then compares the two forecasts on the full 6-year forecast. So it's 6 years period to 6-year period. And you see that between the two forecasts, total revenues are expected to be down by nearly $2.6 billion. One of the factors, the change that comes in at this point is the lower revenues that MDOT gets can support less debt that can be issued because they are approaching their minimum debt service coverage ratios. And in fact, in the draft forecast in fiscal years 22 and 23, the net income debt service ratio drops below the 2.5 number that the department tries to maintain as an administrative goal. It does stay above the 2.0 minimum level that's covered in bond covenants, but you can see that there is nearly $1 billion less in bond premiums, bond proceeds and premiums are expected to support the capital program in the draft forecast. Looking down on the expenditure side of things, operating budgets are expected to be about $325 million less in the next 6 years than they were in the prior 6 years. This is largely reflects fiscal 2021 budget reductions that the department has announced once the revenues started declining. Those revenues, those kind of spending reductions flow through into the baseline in out years, slowly increasing back to more normal levels, but for the 6-year period down over $300 million. On the HUR, the local aid is down $158 million over the 6-year period in the draft. This is simply a reflection of the lower revenue estimates that's used to calculate that state aid. And finally, because capital has the last draw on revenues, the full capital program for state funds is down $2 billion compared to the prior 6-year forecast. Next slide, please. Okay, this then turns to looks at the consolidated transportation program, and it compares the January CTP with the September forecast. The blue part, the bars on the top chart represent the tax and fee revenues the department is devoting to the capital program, and the yellow portions of the bar represent the bond funds that will be devoted to the capital program. the draft is over a third less in state funds going to support the capital program for that period. And the bottom chart on that page shows by mode the full all funds capital programs, and you can see each mode has the percent decrease between the January forecast CTP and the September and right down the line. So that concludes my remarks. I'd be happy to answer any questions.
Thank you very much. Senator, I do not see any questions. So David, you want to wrap it up?
Thank you. That really concludes the DLS presentation, unless there are any final questions.
Okay, thank you, David, and thank you for the presentation. Members, as we said earlier, I think 56-page document here, a lot of information. Thank you for breaking it down for us, David and your team. We want to certainly thank the Senate Budget and Tax Committee, House Appropriations, and House Ways and Means Committee for joining the Spending Affordability Committee. If you look at the agenda for the Spending Affordability Committee, our next meeting will be December 15th at 3 p.m. You'll receive more information the closer we get. That will be decision-making time. So do we have any questions from any of the members or any further comments before we adjourn? Mr. Chairman, you have anything?
I do not, no. Thank you.
Well, thank you all for joining us, and enjoy a dry day, at least for now. So you got time. Thank you.